A high-dividend ETF can hand you cash and quietly eat the furniture. That is why we never diagnose an income fund by yield alone. Today's patient is different. The payout has strengthened, the investment itself has appreciated, and the cash distributions have added real value rather than merely disguising a collapsing share price. But a clean bill of health still requires an autopsy. We need to find out what is producing the income, how much of the return remained inside the fund, and what risks could turn a healthy record into a future problem. Today we're dissecting the iShares Core High Dividend ETF, ticker HDV, using data through August 14, 2026. This is a large value equity fund built around a dividend-weighted benchmark containing 75 high-yielding U.S. companies. The selection process does not simply chase the loudest yield on the screen. It looks for businesses with high earnings potential and dividends considered sustainable. That distinction matters because a stock can offer a high yield for two very different reasons. The company may produce dependable cash, or its share price may have fallen through the floor, while the dividend stands near the edge wondering whether it is next. The fund's first income engine is therefore straightforward. It owns established dividend-paying businesses and collects the cash those companies distribute. The supplied strategy description also identifies an options income component. That creates a second possible source of cash: option premium collected in exchange for surrendering some future upside or accepting another contract-defined obligation. So this is not a magic box that creates money from empty air. It is an equity portfolio whose payout comes from economic activity inside the holdings, trading income around that portfolio, and potentially the return of investor capital when those sources do not fully cover a distribution. Our job is to separate productive income from financial cosmetics. This video is for research and education only. It is not financial, investment, tax, or legal advice, and it is not a recommendation to buy, sell, or hold this fund or any other security. ETFs can lose value, distributions can change, and historical results do not guarantee future performance. Verify the current prospectus, holdings, distribution notices, tax documents, options disclosures, and other official fund materials for yourself. Consult a qualified professional who understands your circumstances before making any financial decision. Let's check the vitals. The fund launched on March 29, 2011. According to the supplied data, pays monthly. It sits in the large value category, meaning the portfolio leans toward mature American companies rather than businesses valued mainly on distant growth expectations. Assets under management stand at $14,940 million. That scale does not make the portfolio safe, but it does tell us this is an established product rather than a tiny experiment surviving on 3 shareholders and a motivational poster. The expense ratio is 0.8%. Cost is especially important in an income strategy because every fee is another mouth being fed by the same underlying assets. A low expense burden leaves more of the portfolio's economic output available to support shareholders, although no fee is low enough to rescue a fundamentally bad strategy. The asset class is equity, and that word should remain visible in red ink. A regular payment schedule can feel bond-like, but the fund owns stocks. Its market value can fall when corporate profits weaken, when interest rates change investor preferences, when a major sector struggles, or when dividend stocks simply fall out of fashion. A calendar full of distributions does not turn stock market risk into a savings account. One data detail also deserves verification in the current documents. The supplied issuer field says dividend equity, while the official description says the fund is issued by BlackRock. That discrepancy does not determine the investment result, but it is exactly why investors should treat a data feed as a starting point rather than scripture engraved on a stone tablet. The current run rate is 7%. That is the figure to lead with because it annualizes the latest 4 payments and asks a practical question. If those recent payments repeat, what would a buyer today collect? The trailing 12-month yield is 3%, and the difference between those measurements is material. The trailing figure looks backward and includes older payments that may no longer describe the present distribution pace. Here, it sits below the current run rate, which indicates that recent payments have been stronger than the broader historical window. That is useful information, but it is not a promise that the newer pace will continue. The latest distribution was 9 cents per share. Mechanically annualizing that single payment produces 4%. That gives us 3 different views of the payout, each answering a different question. The current run rate smooths several recent checks. The trailing measure reports what happened across a longer backward-looking period. The single payment calculation shows what would happen if one isolated check became the permanent norm. None is a contractual coupon. Monthly distributions can vary with dividends received by the portfolio, option market conditions, realized trading results, and decisions about how much cash the fund sends out. A buyer who builds a household budget around the highest available estimate without examining the payment record is treating a weather forecast like a legal guarantee. The right conclusion is not that one measurement must be fake. It is that yield needs a timestamp and a method. The recent income pace is clearly stronger than the trailing record, but investors should budget with room for variation rather than assuming the newest pace has been welded into place. Time for the history. The first 4 distributions averaged 16 cents per share. The latest 4 averaged 17 cents. The direction is up, and the fund deserves credit for that. This is not a payout history slowly shrinking while marketing keeps pointing at a stale headline. That does not mean every individual check climbed in a neat staircase. The latest payment itself shows why one deposit cannot represent an entire distribution policy. Cash payments can bounce around even when the broader direction remains constructive. Think of the history as a road crossing rolling terrain. The important question is whether the destination is higher, not whether every yard slopes upward. The gap between the recent run rate and the trailing yield reinforces that story from another angle. Newer payments have become more generous than the older window would suggest. For an income investor, that is encouraging because the fund is not asking shareholders to accept declining cash while pretending nothing changed. Still, a rising recent average should be treated as evidence, not destiny. The underlying companies can alter their dividends. Option premiums can become richer or thinner as market conditions change. A fund can also adjust what it distributes even when its portfolio remains intact. What the supplied history establishes is that the payout has held its ground and improved across the comparison periods. What it cannot establish is that every future month will cooperate. Now we inspect the price and net asset value path. The latest NAV and price are $29.34, compared with a launch reference price of $19.67. The NAV return since inception is 49%. That is a healthy direction. After distributing cash along the way, the value remaining in each share ended substantially above the reference level. This matters because a distribution is not automatically a return. When a fund pays cash, its assets lose the amount sent out. If the portfolio cannot replenish that value through dividends, option income, appreciation, or other gains, NAV can grind lower over time. A large check paired with a melting investment base is economically similar to celebrating every withdrawal from an ATM without checking the account balance. That is not the pattern presented here. The patient experienced volatility, but the long-term path was upward rather than a staircase into the basement. The maximum drawdown was negative 17%. Healthy does not mean painless. An investor caught near the peak would have watched a meaningful portion of the position disappear on paper before any recovery. Someone forced to sell during that decline would not be comforted by the fund's long-term diagnosis. This creates an important edge case for retirees and other investors spending portfolio income. If the distribution does not cover an unexpected expense, selling additional shares during a drawdown can permanently reduce the ownership base available for recovery. The payment stream may soften the experience, but it does not eliminate sequence risk or the need for separate liquidity. NAV is where an overgenerous distribution policy eventually leaves evidence. Based on the figures supplied, this fund has paid shareholders without hollowing out the underlying share value. Cash distributions since launch total $3.93 per share. Add those payments to the change in the investment itself, and the simple distribution inclusive return since inception is 69%. That is the complete economic picture available in the data. A price-only chart shows the value still sitting inside the fund. The distribution inclusive figure also recognizes the cash that already left the portfolio and reached shareholders. Ignoring the first side makes an income fund look healthier than it is. Ignoring the second side makes a legitimate payout look as though it vanished. Here, the two components work together. The fund did not use cash distributions to distract from a negative underlying result. Shareholders received income while the remaining asset value also advanced. This is where comparisons with a plain equity position require care. A growth-oriented fund may retain more of its economic output, allowing a larger share of the return to appear as price appreciation. An income-focused fund intentionally pushes more cash across the table. Looking only at ending prices would be like comparing two workers by the money left in their wallets after one already paid the household bills. The supplied total return measure is simple and distribution inclusive. It is not a personalized reinvestment calculation. An investor who spent every payment, one who reinvested immediately, and one who owed taxes along the way would experience different outcomes. Even so, the measure answers the central autopsy question. Did the payout add to a functioning investment or merely compensate for capital destruction? In this case, it added to a functioning investment. Now we open the machine. HDV tracks the Morningstar Dividend Yield Focus Index. Its leading positions are ExxonMobil Holdings Corporation, ticker XOM at 8%, ABVI Inc., ticker ABV at 6%, Chevron Corporation, ticker CVX at 6%, Verizon Communications Inc., ticker VZ at 5%, The Home Depot Inc., ticker HD at 5%, and the Procter & Gamble Company, ticker PG at 5%. That lineup reveals the portfolio's personality. There is meaningful exposure to energy, healthcare, telecommunications, home improvement, and consumer staples. These are operating businesses selling fuel, medicine, connectivity, household products, and goods tied to home spending. Their corporate dividends form the first layer of the fund's cash supply. The screening process seeks both earnings potential and dividend sustainability. In plain English, the index is trying to avoid buying a company merely because a crashing share price made yesterday's dividend look enormous. No screen is clairvoyant, but the design at least asks whether the business appears capable of supporting the payment. Dividend weighting also changes the risk map. The portfolio is not weighted solely by company size. Businesses contributing more to the income objective can receive greater influence. That can create useful income exposure, but it can also concentrate the portfolio in sectors where dividends are common. The energy allocation illustrates both sides. Strong commodity economics can support substantial corporate cash flow. A difficult cycle can pressure profits across more than one important position at the same time. Diversification means the fund is not dependent on a single company, but two businesses exposed to related economic forces are not two completely independent sources of safety. The supplied mechanics add an options income layer. An option buyer pays premium for a contractual right. The fund collects that premium today and accepts the corresponding obligation. In a covered call style implementation, the fund can sell calls against portfolio exposure. From here, investors should watch 5 things. First, compare each new distribution with a rolling group of recent payments. One unusual check can distort a single payment analyzation, while several payments reveal whether the present pace is becoming durable. Second, monitor NAV across complete market cycles. A temporary equity decline is normal. A persistent downward path while large distributions continue would indicate that the payout is consuming more than the strategy replaces. Third, inspect current sector weights. A rules-based portfolio can change as companies pass or fail its screens, and an income advantage can become a concentration risk when several major holdings respond to the same economic force. Fourth, read the latest options disclosures. Coverage, strike selection, expiration dates, and implementation determine how much upside the fund may exchange for present cash. A mild overlay and an aggressive one can behave very differently during a rapid rally. Fifth, check the tax character of the distributions and compare the strategy with the job your portfolio actually needs done. An investor seeking maximum long-term growth may dislike surrendering upside. Someone prioritizing current cash from established companies may find that same compromise entirely reasonable. The key is to watch for change. A healthy historical record is valuable evidence, but it is not diplomatic immunity from future mistakes. Clean bill of health. The verdict follows the evidence. The fund's underlying value appreciated, its distributions improved across the supplied comparison periods, and including the cash payments produced a stronger result than the price path alone. The payout did not merely decorate a deteriorating investment. This appears best suited to an investor who wants current income from established U.S. companies, can tolerate normal equity volatility, and accepts that an options overlay may sacrifice part of a powerful rally in exchange for cash today. Its low cost and substantial scale strengthen that case. The risk is not hidden death by spectacular yield. It is the quieter possibility that future holdings weaken, option decisions become too restrictive, or distributions outrun what the portfolio can economically support. Those are real concerns, but they are conditions to monitor, not evidence of an existing failure. The patient is alive, productive, and paying its bills. Just remember what a clean diagnosis means. The machinery is working now. It does not mean you stop checking the pulse. 2 quick things before you go. If this teardown helped you see past the headline yield, hit the like button. It genuinely helps the channel. Subscribe so the next ETF Autopsy lands in your feed. And drop a comment. Which ticker should we put on the table next, and where do you think the real risk is hiding? We read everyone. Thanks for watching.